Here's one ETF that can double your S&P 500 returns, but there's one big risk. That ETF is the SSO, or the Ultra S&P 500 ETF. So this ETF seeks to double the daily investment return of the S&P 500. But the big risk is if the market moves in the other direction, then you also double your investment losses. And that's because of ETF decay, because when the ETF goes up, it doubles in price, but when it comes down, it also doubles your losses. And when it comes down, you now need to make a lot more just to get back to break even again. So because of the daily volatility, it doesn't make sense to invest in this long term. For example, now I'm showing you a table of the hypothetical returns of the S&P 500 over 5 days and the 3 times leverage ETF at the bottom. For example, on day 1, the index goes up 10%, but the 3 times leverage ETF goes up 30%. On day 2, the index goes down 5%, but the leverage ETF goes down 15% because of leverage. As you can see, at the end of it, even though the index returned about 3%, your leverage ETF only returned 2%. So it doesn't really triple your investment over the long term. And this is just over 5 days. So because of this, leverage ETFs don't make sense for a long-term investment and is really used for short-term trading purposes.